Hey. Happy Sunday night here. Uh, Let me just start off by saying thanks for joining us tonight. I think we're going to have a particularly busy week coming up. So when I was thinking about what I want to talk about and sort of what we're going to cover this week, there was sort of a lot of material, but we'll touch on a few key areas. Uh, uh, right off the bat, I think what we want to focus on is the fact that there's a lot of US based news coming out this week. A lot of big indicators are going to be happening. And we'll also talk about some global pieces as well. But I think there's just a lot of really important U.S. news that are going to be affecting the markets to some degree. So I would just say keep your eyes on that as always. So first and foremost, appreciate you watching. Always appreciate the likes on the videos when you can. And if you're not subscribed, please do so. But in the interim, I just want to say, as we start to learn more about macroeconomic events, how these are affecting what's going on in our portfolios, as we talk about all the time, it's just a good habit to start marking down on the calendar or creating notifications in and around when these events are happening. And then it helps you to understand what you need to pay attention to, what to be aware of. And what I would also say is just challenge yourself to know when the companies you own are having earnings, and also understand what those earnings are likely to be, what the analysts think they're going to be telling them, etc. Doesn't have to mean you go crazy, but it's a big deal. I want to start off this week explaining something real quick because it's important for some of the things we're talking about. Consumer confidence is a key indicator that we often look to in the US and globally as well from a macro perspective. And the idea here is that consumer confidence really measures the optimism of the US consumer. The idea behind this is that when consumers feel very confident, they're more likely to go out and spend cash on hand or, debt, etc. And when consumer confidence is low, of course, the inverse, they are likely to save more or not spend, generally speaking. So this is important because, excuse me, one of the things we're expecting this week is to see a consumer confidence reporting. We just want to have a general idea of what's happening with the June jobs report, as well as a few other things. So really, in a nutshell, this is going to be a pretty busy week as far as economic data that's coming out. And I think it's going to help us get a good feel for how things are going with the state of our economy, how we're looking from a recovery perspective. And I think we all know that the recovery's been pretty good so far, but just good to know what's happening. In a nutshell, on Friday, we know the Labor Department's releasing its June jobs report. What I think we're expecting and what I'm hearing from most everyone I talk to is that we're looking to see that job creation has been really strong and less people are on unemployment. Take that as you will. I think that's a positive overall. What I also think has been tough, just from sort of seeing this in my own life, is there are a lot of businesses near me where they're having real tough times filling roles, getting people into the jobs. And I don't know how direct this is related to anything that's going on politically or from that spectrum, but I do think it's important to note that when we can't get anyone to fill open roles, that's generally a concern, at least in my opinion. So just something to keep in mind, as you're going through this, to think about like, how is this impacting some of your more retail-based locations, restaurant-based locations, etc. We actually had dinner tonight, my wife and my kids and I, and it was a restaurant we like to go to a lot. And I happened to be talking to the waiter who looked absolutely exhausted. And he was saying to me that he has been working all day with only one other person. And that's been the standard because, frankly, they can't find people to help. I have another friend who owns a dental practice, and he's having trouble filling roles there as well. So I do think there is some anecdotal evidence of the fact that, with unemployment being high and also unemployment checks being rather high, and for good reason too as well, but it is going to affect how things are going. So as we're seeing more states sort of reducing or stopping that, I think we're going to see some of these jobless numbers improve, which is just great in general for the economy. The other big thing we're expecting as well is non-farm payrolls. There is an expectation of a growth of 700,000 for June. This is actually coming right from Bloomberg's consensus data. So that's a pretty big jump from what we saw in May, which was around 559,000. And I think this would be a very, very positive sign for the economy in general. Obviously, more jobs, especially with the price of real estate, especially with the acceleration of the markets, is just a good indicator that things are sort of on the right track. I always think should operate with some degree of concern, but it's just good to be aware. And this is what we're generally hearing, is that like we're just seeing less layoffs, more jobs coming in on a steadier basis. So this is a good thing for sure, and something I think is worth paying attention to. So for what it's worth, I think it's a big thing. I know that some of the things we've definitely seen as well is it's sort of, this is going to be a little bit sounding like I'm going on the inverse again, but I think it's worth noting at the same time that we're seeing a lot of maybe on the the lower earning spectrum as far as like jobs go, we're seeing a lot of trouble filling those roles. On the flip side, I think what we're also seeing is people are realizing they can negotiate at a much higher degree. People don't seem to be really staying in jobs they don't want right now. I think more than anything, there's just been a lot of job mobility, especially with the idea of working from home. I'm never a big fan of using anecdotal evidence to support my thought process, but I'm going to do that in this case for a second. I think one thing I'm seeing a lot is people are sort of treating the ability to now not have to go back to an office as a perk to a job. And if they're in a position where they're being required to go back, I think they're treating that as an opportunity to say, you know what, I'd rather look around, maybe even take a little bit less, but have that flexibility in my lifestyle, whether that's to have more family time, less commute, general better balance of life. So you're not spending time being non-productive sitting in a car. I get it totally. We're seeing also that there's a bit of a supply and demand issue in general, where we're not getting the match we usually expect in the labor market. So everyone from like FedEx to Yum Brands, et cetera, as I was reading earlier, have been really experiencing this as well. Yum Brands on one end and FedEx really on the other, but still goes to the point that there are jobs out there. It's just a question of who's filling them and what are the expectations. Because I think that's a really big thing we miss oftentimes is it's easy when we look at the data that's coming out to say, well, there's plenty of jobs. I don't know why people aren't taking them. Well, there's a certain balance. Not everyone's going to take a job simply because it's there if they have that ability to get unemployment and hold off to find what they'd rather do or something quite better. So just keep that in mind, because you don't know within your portfolio what kind of exposure could cause an issue for you in terms of, will reduce workers reduce revenue? Will it have long-term impacts? Maybe conversely, it also means less capital expenditure on employees as well. So something absolutely to keep thinking about. And I think this is where again, as we talk to, is like getting a little bit outside the norm of just understanding earnings or understanding technical analysis. There's always these things that sit on the outside of your portfolio that you need to pay attention to, and can frankly have a really big impact on, what's going on with your portfolio and how you're managing the risk that lives within it. One other thing as well, I mentioned this at the very beginning of of the video, is consumer confidence. So we're expecting to get June's consumer confidence index shortly. We're expecting from the Bloomberg consensus as well, because that's where I pull a lot of these numbers from, is there's an expected rise to 119, which is up from 117.2 in May. So again, the reason this is such a big deal is this would actually be the highest level since we've seen in February 2020, which was at 132.6. So things were really good back then, but the good news is we're starting to head back towards that way. Now, one caveat, and I actually took this out of an article I read earlier, that number that I'm referencing from February 2020 was actually a 2-decade high. So the fact we're even starting to get back there is just a sign that consumer confidence overall is doing pretty well. And there's a lot of corollary between the idea of the way consumers look at things and the way investors look at things and the way sort of that long-term ability to look at everything goes out there. So, I think people have to be comfortable with inflation, both from a consumer perspective as well as from an investor perspective. Usually when you're seeing consumer confidence rise, plus you're seeing the home prices up, you're seeing the joblessness going down. In general, I don't think that means people don't see inflation. What I think it means is that people are realizing it's a workable number or an inflationary pressure that we're sort of able to get our arms around. I for one, am always very cognizant of inflation, how it can affect the things that I'm doing, the savings rates, the earnings, my benchmark for what I have to get above from overall portfolio earning perspective. So again, if your entire play is to earn dividends at 3%, you really need to pay attention to the inflation rate. If you're in really high growth asset classes, maybe you look at things differently. And I think that's a consideration as well, to know your style of investing and how it can be affected by these external forces. So, I think these are a couple of the big things. I'm going to run through sort of the dates and what we're expecting as well. All this being said, before I even talk about these things, I think it's really important to note that consensus is not fact, and indicators are not always right. So always, always, always be in a position to protect yourself if it goes the wrong way, or if you're making a bet in and against it. And if you're thinking to yourself like, well, I don't really, I own stocks or bonds or mutual funds, et cetera, and index funds, I don't worry about these things. For sure, I get that. But there are a lot of people who I know who do watch this channel who focused on, intercountry foreign currency exchange. We have a lot of people who are looking at bond rates tied to inflation. We have a lot of people who are playing VIX. So the more complex your portfolio gets, the more you need to be aware of what's in it. And I say this all the time that you might think you have a really basic index fund, but there could be some derivative play in there. So just good to be aware of. So real quick from an economic calendar, and I don't normally do this. I thought maybe I'd try it tonight, and if I get feedback, good or bad, I'll use it for the future. But just to run through a couple of key things happening this week. From a calendar perspective, on Monday, we have the Dallas Fed Manufacturing Activity Index. We're expecting a 32.5. We had a 34.9 in May, and that's, again, June is expected at 32.5. On Tuesday, we have the FHFA House Price Index, which is a month-on-month indicator. The expectation for April, because it's a bit of a lagging indicator, is 1.7. We had 1.4 in March. Also on Tuesday is the S&P CoreLogic Case-Shiller 20-City Composite Index. I know it's a lot, but it's good to know these things. The month-over-month for April there is expected to be 1.8. It was 1.6 for March. We also know that the S&P CoreLogic Case-Shiller 20-City Composite Index, from a year-over-year perspective, we're expecting to see April coming in somewhere around 13.27, or at least that's what I think it was from March. I might have to double-check that number and get everyone back on that. And then additionally, we know the Conference Board Consumer Confidence Report is expected to be 119 for June. It was 117.2. We already talked about this. We're starting to ramp up to our 2-decade high of 132 and change from last February 2020. On Wednesday, we have the Mba Mortgage Applications for the week ending June 25th. There was a 2.1% during the prior week. ADP employment change. For June, we're expecting about 575,000. Overall, we had 978,000 in May. We also have pending home sales month over month. In May, we're actually expecting a negative 1%. We had a negative 4.4 in April. So again, that was all just Wednesday. So that's why I'm starting to do this a little different. And I might actually write these up and think about how to deploy them. But again, I'm going to keep going because I think there's some other stuff that's really important this week. And if you're not clear on what these things mean, hit me up with a message, let me know. But I think it's important to call it out. Now on Thursday, we have the Challenger job cuts. We have a year-over-year expectation for June. We had a 93.8 negative in May. We also have initial jobless claims, which ended June 26 at 380 expected. 411 was the prior period. We have continuing claims on Thursday as well. So week ending June 13th was 3.39 million during prior week. Market U.S. manufacturing PMI, we're expecting. We're expecting construction spending month over month. We're also expecting ISM manufacturing. So again, that's all just on Thursday. So I'm going to stress this again. There is a lot going on. And I just want to call it the fact that you're sort of either keeping track of these things or you're not. So it's really important to have a system for tracking what's going on from macroeconomic perspective again. And then I'm going to hit you up with Friday here and then go into a couple of earnings pieces as well. So on Friday, this is a particularly big deal. And I think that everyone should start to at least get a feel for knowing what they mean and why it's important to follow it. All of what I'm going to say right now is going to be Friday. I'm going to go through pretty quick because there's a lot, but we're expecting a change in non-farm payrolls of 700K is the expected number. We had 559K in May. We're going to get the unemployment rate, the average hourly earnings year over year, the average hourly earnings month over month. We're going to have the trade balance for May was negative 71 billion is the expected number. We were negative 68.9 billion in April. We'll have factory orders. We'll have durable goods orders. We're going to have durable goods orders excluding transportation. We're going to have non-defense capital goods order excluding aircraft. And we're going to have non-defense capital goods shipments excluding aircraft. Now, this is a lot. I don't expect you to know or be comfortable with what each of them are. But what I would do is really start to get a feel for, are we exceeding numbers? Are we hitting expectations? Are we missing them on the low side or are we missing them on the high side? Because if we're missing things on the low side, this means that from the consensus, we're not growing at the rate people are expecting. We're not seeing the kind of growth that we would think should be happening. So this means there can be negative impacts to the stock market, assets, etc. This is a funny game when you get into really looking at these things and understanding the impact, because there can be some huge things that happen that cause no impact whatsoever, and there can be what seems like small things that can have a huge impact. So the reason I'm calling this out, as I often do, is you have to just continuously make sure you're in a position to be able to protect yourself and your portfolio. And again, that's the real key here. It's not just about knowing random numbers on random dates for random indicators. It's about what happens when things miss, what happens when they're strong. And you don't have to necessarily know what that number is or why that number is important. What you have to start to understand is, if non-farm payrolls are really strong, well, what happened last time they were really strong? Did the market explode upwards? Did it stay in a range and be flat? Did it crash down because it was too many at once? So we think there's a mistake. Those are the kind of things you want to start to really do and focus on as a serious investor, growing a portfolio and working towards your goals, regardless of what they are, right? I mean, I think some people, they have a goal of paying off their house and being financially independent. I think some want to have a strong retirement when they hit 67. I think some want to drive a Lamborghini when they're 22. I get it all. I mean, whatever is you, you got to do you. But all these numbers affect us the same in the way they affect our portfolios. So just really get in there and get a feel for it. One other thing I'm going to touch on before I jump to a different topic is we have the earnings calendar for the week coming up, just on top of all the other sort of indicators that are coming out from a macro perspective in the US. On Wednesday, we also have earnings from Constellation Brands, Bed Bath & Beyond, General Mills, all before the market opens. And then after the market closes will be Micron. So a lot of names in there. I'm going to say it again: Constellation, Bed Bath & Beyond, General Mills, Micron, all going to be on Wednesday, some before, some after. And on Thursday, we're going to have Walgreens Boots Alliance before the market opens. So there's a good chance that somewhere in your portfolio, in a mutual fund, in an index fund, one of those names I mentioned is probably in there somewhere. Maybe it's not heavily weighted. Maybe it is. So just things to keep in mind there. I actually, funny enough, speaking of General Mills, I did a video a few months back on how to basically get free cereal for life as a fun video on the dividends earning from General Mills and how much cereal you could buy a year, et cetera, et cetera. So just, again, like even some of the videos I've done in the past, I pay attention to these things and want to know when the earnings are going to be coming around. So that's my piece tonight on what's happening from the perspective of indicators and earnings. What I also want to call out was sort of, we're seeing some unique and interesting things happening in India as an example right now. I think India is a really big indicator sometimes of a global perspective because both of population, both of the technology focus. We're starting to see Indian investors making a shift away from gold, which has traditionally been a favorite asset class. And we're seeing more of a shift into crypto. Now, take that as you will, good or bad. I don't even have an opinion on it, frankly, yet until I see some real numbers other than just headlines. But I think it's really interesting that as we're seeing, I'm just going to talk about Bitcoin because I think there's enough information about all the others that are out there. But just at Bitcoin as a proxy for this thought process, I think that in terms of Bitcoin being sort of sitting at this, like, we'll call it 30 to 40 to be generous on sort of the range here. But we've seen it sitting now between 30 and 40 for quite some time. I think there's been a lot of different ways to look at this. Maybe the price got too high too fast. Maybe we ran out of buyers and the sellers overtook it. It could be that institutional buyers are keeping it where it is today. I know that every time it drops down below 30, we seem to pop right back up into the 30s again. I have seen just an absolute boatload of information on both sides of this as to why Bitcoin's going to fail. Bitcoin's going to be super successful. I saw a report out today that we're still expecting numbers as high as 160K by the end of the year. Other people are predicting could be down as low as 7,000 per year. When you think about that and the absurdity of the reporting in and around that, this is why it's so important to do your own research and believe in what you put in from a mathematical, a macroeconomic and a fundamental. It could be looking at social media and putting it all together and getting a feel. It could be on-chain analytics. But either way, as a proxy for the way that you think about investing, risk, trading, etc., we're seeing the movement in countries like India from gold into crypto. It doesn't mean that people are leaving gold. It just means there's a recognition. It's being recognized, not a recognition. It's definitely not a word, but it's being recognized that there has to be this moment of diversification combined with some speculation. And again, I'm not a financial advisor. I'm not pretending to be one. This is just the news that I'm reading and giving back out there. But I think it's important to get a feel for, is this indicative of a trend? We keep seeing the celebrity battles, the Dorseys versus the Musks. We've got Cuban all over the place. These are just opinions. They are not smarter than you are. Maybe it's some things they might be, but you probably are at other things as well. So it's really good to treat all these different factors as just different indicators. There's low prices, there's high prices. There's celebrity executives giving their opinions. There's different types of data that can be interpreted in different kinds of ways. I hear a lot of people calling this an accumulation phase. Other people are calling it a fizzling out of buyers, keeping the price high. What I think is really interesting is as we see El Salvador, frankly, trying to move forward, giving $30 worth of Bitcoin to all of its citizens, to the tune of well over $100 million. I think that there's an opportunity to think about where there's a fit in your portfolio for any kind of alternative asset. I know we're talking about crypto right now, but really could be anything. But I also think, and I say this all the time, and I'm sure people are so tired of hearing it, just set a floor for what you're willing to lose and put in a stop loss, put in a hedge to protect yourself, right? But one thing I'm going to throw out there that seems to be very popular, and this is also my thoughts, again, just my thoughts, just for my own 2 cents here, not financial advice in any way. I think there's something to be said for not leveraging margin, period. Forget about for equities, forget about for, more secure asset classes. But when you're leveraging margin at will in your portfolio for things like super speculation on crypto, for futures, for options, just make sure you really have a strong baseline, because any of the many indicators I mentioned at the beginning of this video are from the government perspective, from payroll to consumer confidence, as well as earnings of all these different brands. All of these things roll up into the market. And the market, in a lot of ways, is living and breathing on its own. And all these different pieces can represent big changes based on news that you don't know of or that you're not aware of yet. And I think it's important sometimes to take a step back. I talk about doing this on Sunday nights all the time, and I really do mean it. I think it's very, very important to take a step back and think to yourself, what are the odds that I know more than everyone else about what's happening? And maybe you feel like you have it down pat. You're the first to know when there's a big change. Maybe Constellation calls you before they call the analyst to tell you how their earnings are going to be. I don't know. Maybe you get non-farm rolls before I do. But for myself, I just assume I'm the last to know. And if I'm the last to know and something major happens, what have I done to ensure that I'm not affected by it in a way that I can't recover from? This is where you learn the techniques to understand your portfolio, have balance in it. And a lot of times you can do this by copying strategies that have been around forever. Just proper portfolio balance, proper risk mitigation, understanding of how derivatives are used. I'm not suggesting you even use them, but I'm just saying if you're going to take out huge risk by using things like margin or hugely speculative positions in your portfolio, also balance it by knowing the way to get out of it and around it and quickly save yourself if there's a downtrend. Because when we saw this big price crash recently with Bitcoin, I did a video on this as well, but there was a lot of people out there who were saying the reason it crashed so bad was basically because of all the margin positions blowing up. So anyways, I got a lot out here. I didn't even want to get into this topic, but I ended up doing it again as usual. So thanks so much for watching. We really appreciate it. If there's topics you think would be more interesting to cover, or there's something you want to learn about, or you're just looking for an opinion on a term you don't know, an indicator you're not sure about, things like that, please let us know. We're happy to do videos on anything. So with that, I hope you have a great week. Pay attention to the indicators. Know if your companies have earnings. And otherwise, have a good day, good night, good morning, whatever the case is, and we'll talk soon. Thanks so much.